How do banks know if they have enough cash to survive a crisis? Not just today, but if markets crash tomorrow, if depositors rush to withdraw their money, or if funding suddenly disappears. They don't rely on guesswork. They use something called liquidity modelling and stress testing. It's how banks simulate extreme but realistic scenarios to see if they can still meet their obligations under pressure. It's part forecasting, part risk management, and part war game, and it plays a critical role in keeping the financial system stable. In this video, we're going to break down what liquidity modelling really is, how stress testing works, why regulators demand it, and how banks use it to prepare for the worst before it happens. So let's dive in. So what exactly is liquidity modelling, and why do banks need it? Well, let's start with the basics. Liquidity modelling is the process banks use to forecast their cash inflows and outflows across different time horizons, anywhere from tomorrow to the next 12 months or more. It helps answers a simple but vital question. Will we have enough cash in the right place at the right time? Now, to do that, banks build detailed models that map out their expected cash movements. These models include everything from customer withdrawals and loan repayments to trading activity, margin calls, and funding rollovers. But modelling isn't just about predicting normal conditions. It's also about planning for the unknown. And that's where stress testing comes in. So what is stress testing, and how does it work in the context of liquidity? Well, stress testing is exactly what it sounds like. It's about testing the bank's resilience under stressful conditions. In liquidity stress testing, the bank simulates one or more extreme scenarios, like a market crisis, a credit downgrade, or a loss of depositor confidence, and asks some fundamental questions. Can we still meet our obligations? How long can we survive without new funding? So let's say a bank assumes that 25% of its corporate clients pull their deposits over a 5-day window. At the same time, markets freeze and repo funding becomes unavailable. Meanwhile, collateral values drop and the bank faces margin calls on its trading positions. That's a stress scenario, and the bank must assess how much cash it needs, what assets it can sell, and how long it can operate under those conditions. Now, stress tests usually fall into two types. First, idiosyncratic stress, so a problem specific to the bank, like a scandal, cyber attack, or downgrade. And then a market-wide stress, so a broader shock that affects all banks, like a financial crisis, pandemic, or war. And sometimes you combine the two to see how things stack up in a worst-case double-hit scenario. So how do banks then build these models, and what makes them realistic? Well, liquidity models are only useful if they reflect realistic assumptions. So banks don't just guess. They use historical data, behavioural patterns, and expert judgment to then estimate how different parts of the balance sheet will behave under stress. For example, what percentage of retail customers will withdraw their savings if the bank gets bad press? How many wholesale depositors will leave if the bank's credit rating drops? How quickly can the bank sell its government bonds, and at what discount? These assumptions are baked into cash flow projections, broken down by day, week, and month. The model shows the net liquidity position, i.e. how much surplus or deficit the bank expects over time under different scenarios. Banks also use tools like survival horizons. This tells them how many days they can operate without running out of cash if no new funding comes in. And to keep models honest, many banks run reverse stress tests, asking what would it take to break us, and then working backwards to identify weaknesses. Now, what role do regulators play in liquidity stress testing? Well, liquidity modelling and stress testing isn't just a best practice, it's a regulatory requirement. After the 2008 financial crisis, regulators realised that banks had focused too much on capital and too little on liquidity. When markets froze, some banks had enough assets, but not enough cash to stay afloat. That's why frameworks like the Liquidity Coverage Ratio, or LCR for short, were introduced. LCR requires banks to hold enough high-quality liquid assets to survive 30 days of severe stress. Now, to comply, banks must model stress scenarios and report how they would manage liquidity over that 30-day window. In the UK and EU, the Internal Liquidity Adequacy Assessment Process, or ILAP for short, is another key requirement. This is where banks document their liquidity risks, modelling assumptions, funding strategies, and governance processes. Supervisors review these documents, challenge the assumptions, and may even run independent liquidity stress tests to check for resilience. So yes, liquidity stress testing is not just about good risk management, it's also about satisfying regulators that the bank won't be the next crisis headline. So what challenges do banks face when doing liquidity modelling and stress testing? Well, modelling liquidity sounds neat in theory, but in practice, it's messy. First, liquidity isn't uniform. Some assets are easy to sell, like government bonds. Others, like complex securities or certain loans, might take days or weeks to liquidate. Knowing which assets count as real liquidity is tough. Second, behavioural risk is unpredictable. Customers don't always act logically in a crisis. Wholesale depositors might pull out faster than expected. Customers might withdraw more than they planned. It's hard to model emotion, model panic, or herd behaviour. And third, data quality matters. You need accurate, timely data on your assets, liabilities, collateral, and funding lines. If your data is fragmented or delayed, your model may give you a false sense of security. And finally, coordination is key. Liquidity risk touches many teams: treasury, finance, risk, IT, business units. Getting everyone aligned on assumptions, scenarios, and contingency planning is no small feat. That's why liquidity stress testing is both an art and a science. Now, you might be thinking, why does liquidity modelling matter for the financial system and for everyday people? Why should I care? Here's why. Liquidity modelling is what helps prevent bank runs, market freezes, and domino effect collapses. It ensures that your bank can still give you your money even in a crisis. It gives regulators early warning signs, and it forces banks to think ahead rather than scramble after the damage is done. Without robust liquidity modelling, the next market shock could take down institutions that look strong on paper but were hollow underneath. And for investors, depositors, and regulators alike, that's a risk no one wants to take. So what's the big picture when it comes to liquidity modelling and stress testing? At the end of the day, liquidity stress testing is about building resilience. It's about asking the uncomfortable what-if questions before reality forces you to answer them. It's one of the most important tools in a bank's risk toolkit, and when done well, it can mean the difference between riding out a crisis or becoming part of it. So here's something to think about. If your bank lost access to all new funding starting tomorrow, how many days could it survive? Let us know in the comments below. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.